US hedge funds are starting to buy these Chinese stocks which are at 52-week lows. They've become very bullish on China lately, and now we want to find out, are these undervalued Chinese companies a buy now? We're going to take a look at a few of these. We're going to run through each one of them through our valuation model. We're going to get to the intrinsic value as well as the acceptable buy price, given our investor margin of safety, and we'll also look to Wall Street to see what they're forecasting for these companies over the next 12 months. And as a quick spoiler alert, these companies have massive upside. We're talking between 50 to 100%. So let's take a deep dive and find out what is going on in the Chinese market. We're going to take a few of these stocks that we can see from this article from just last week over the 11 most promising Chinese stocks to buy according to analysts. And what we want to understand is that the hedge funds only just a few months ago were all talking about China as a very bearish market. And what we can see from this article here is that Bridgewater Associates, one of the largest hedge funds in the world, in fact, the largest hedge fund by assets under management, founder Ray Dalio said that they are moderately bullish on Chinese stocks and that they are worth holding for the long term. Now, this isn't the only article. There are many articles out there, especially the Financial Times. They talk about whether or not Chinese stocks are in a value trade or a value trap. Now, Chinese stocks have been declared uninvestable, and the point here is that they're trying to put across is when assets do become classed as uninvestable, it is most often the time to buy. So let's jump into the first stock today that is trading at a very, very cheap price. We'll also discuss some of the bearish case scenarios of investing in the Chinese market. So the first one is Alibaba, which we have discussed on the channel many times. Now, over the last year, they are down 34%. We can see they are pretty much trading right there towards their 52-week lows. They have recently offered a yield. It currently sits at 1.39%. A forward PE, very cheap forward looking of 8.2. Over the last 10 years, what we can see is it has peaked at around $307 in 2020. And this stock was trading in 2014 at around $88, so at a higher price than the current value. Now, in terms of the dividend safety, we don't have a score just yet as they only recently started paying dividends, but we can see their market cap is $181 billion. They are a mega cap company. In terms of their metrics, so we can see, given they have just started paying a dividend, the payout is around 11%. Now, for new viewers, with any earnings data, we do tend to put it to one side. It is susceptible to manipulation by management through accounting. So free cash flow, I like to see below 60% because it gives me faith management can offer those double-digit increases. 11% in 23, 11% expected in 2024. For Alibaba, I'm expecting a strong double-digit increase to their dividend. Free cash flow per share looking very strong as well, $9.84 in 2014, $63 in 2023. It is growing at a very strong rate. We do note some inconsistencies where it does fall, but over the longer term, not only is it increasing, but at a very rapid rate. $65 expected in 2024. Sales growth, strong double-digit growth to the top line year on year. Just something I would say is to be aware that it has been slowing down. So potentially one to look at in 2024 with their guidance as well, due to the fact that 2023, their top line only increased single-digit 2%. Although we do note the very rapid growth, $53 billion in 2014, $870 in 2023. They've done share buybacks, they've also done share issuances. The net position would have been a share dilution of your shares, $2.33 billion in 2014, $2.64 in 2023. ROIC, now for me, this makes up one of my 7 golden dividend metrics. I want to see 10% or more to give me faith management are able to effectively allocate their capital. This would be the minimum I'd really want to see. It does straddle around 9 to 8%, 8% in 2023. Not the greatest. I would like it a bit higher in my own personal view. Both operating margin and free cash flow margin are a very similar story. They are decreasing their margins year on year. So this is something that I would say be very, very aware of. Keep a very close eye on. Nonetheless, they are still not that bad in terms of the numbers. We want to see a minimum of 12% on the operating margin, a minimum of 7% on the free cash flow margin as well. Net debt to EBITDA, earnings before interest, tax, depreciation, amortization. It shows us two things. Firstly, dividend safety. Secondly, the essential strength of the balance sheet of a company. It shows that Alibaba, it wouldn't even take them one day to pay off all of their debt net of cash on hand. So a very strong balance sheet. So let's get into the valuation. As always, if you enjoy the content, values being provided, smash that like button, hit the subscribe and bell button so you are continually notified of these videos as they drop. And typically on the channel, when we do deep dives, we do run through every single one of these models. Today's episode, we're going to jump straight into the intrinsic value. And for Alibaba, it does arrive at $145. So we can see with a current price of $72, typically the margin of safety, we start off with 10%, which we use if we believe it meets three criteria: wide moat, strong financial metrics, good forward-looking data. We keep going until it's near the current trading price. Now for Alibaba, we do see a massive sign of a margin of safety. At 50%, it is around that current value. So based on our estimates and judgments of Baba, we see a 50% MOS. Now in terms of Wall Street, what they forecast over the next 12 months, they see upside of 60%. They have a price target of $115. As always, when we run through these stocks, drop your thoughts and comments below whether or not, one, you'd like to invest in the Chinese market, and two, whether you've been adding any of these significantly undervalued stocks. We then move on to the second stock, which is undervalued at its 52-week low. We have JD.com. Now, over the last year, plummeted down 60%. Again, trading pretty much a few dollars shy of that value. The yield just under 3% and the forward PE 7.52. If this is one you've been holding over the last 10 years, again, similar to Baba, we see its all-time highs at over $100, $104 in February 2021. And if you held this in June 2014, you would be right now still at a loss. So they don't have a dividend safety given similar to Baba. They just recently started paying a dividend. Market cap, $35 billion. It is a large cap company. In terms of that payout ratio, similar again to Alibaba, very low, 20% in 22, 21 expected in 2023. So I would expect strong double-digit dividend growth. Free cash flow per share, it has also been increasing, 269 to 2090, expected to go higher in 2023 with a small dip in 2024. Over the longer period though, very nice to see growth, which is always strong, especially when we focus on that free cash flow per share. Very similar story again with Alibaba. There is strong double-digit growth to the top line, although we do note it is slowing down. So this is one area for these companies that I would keep an eye on, just to see whether or not top-line sales are slowing or whether or not it is just a bump in the road. Although when we look over the last 10 years, it has gone from 69 million in 2013 to 1.07 billion. Shares outstanding as well, they do essentially share issuances, so similar to Baba, your position would be diluted over the last 10 years, 847 million to 1.59 billion. Return on invested capital, we can see here over the last few years, it is very low single digit. 2023 at 7% is nice to note it has increased from the last few years, but still pretty low, something that I personally would keep an eye on moving forwards. Operating margin, this is a bit of a red flag indicator. We do see over the last few years, it is very low. In fact, from 2013 to 2018, it was in the negative. It is nice to see it increasing to 3% in 2023. But again, this is something I would keep an eye on. You want to ensure that it continues to increase. I'm definitely nowhere near the negatives. Free cash flow margin, a little bit better, but still a little bit too low. I want to see a minimum of 5%, ideally sitting around 7%. Net debt to EBITDA, similar to Baba. Again, a lot of metrics here that are very comparable. 0 in 22, 0 in 23, 0 expected in 2024. They have a very strong balance sheet. No worries to note there. So let's get to the valuation, which is always important, especially when there are risks with different companies in different countries. The intrinsic value here then is sitting at $43. Margin of safety, we can see then when we start off with 10%, it is a buy up to $39. At 20%, a buy up to $35. And again, similarly, we keep going until we get to the point where it is near the current trading price. So we see around 45% margin of safety with JD.com. What are Wall Street themselves forecasting? 88% upside. They have a price target of $42. So as we mentioned earlier, a lot of these hedge funds are now starting to buy a large amount of Chinese stocks. This one in particular, upside very, very high. Now, before we jump into the next stock, just to let you know, we do have a free weekly newsletter, different topics every week. If you want to join completely free, click on the pinned comment below. A few of our articles, we've discussed undervalued companies with strong upsides in 2024. Also, look through our 7 golden dividend metrics where we talk about our undervalued screener for finding those golden companies. So let's jump in now. Before we do take a look at the next stock, we just want to talk about some of the issues with investing in China that you may or may not be aware of. 3 main ones. The first one, the geopolitical tensions between the US and China. You need to be aware of this, as this will have an effect on those stocks. We also have a topic here around the economic growth, whether or not China is the next Japan. And for those that are unaware, do take a look at the historical performance of Japanese stocks over the last 10 years. And then we also have the regulatory issues, whether or not China does close down or they do clamp down on stocks. It is something that has taken a massive toll on a lot of Chinese companies over the last few years. One thing that I think a lot of people don't understand, and it's talking about what do you own when you invest in Chinese stocks. When you buy a company such as, or shares in a company like Coca-Cola, you have, say, 10 shares of that company. With Chinese stocks, it isn't necessarily the same. Now, it explains it quite here. Now, many investors may be surprised to find out that despite spending money on what they presume to be stocks, they don't actually own anything in China. It walks and talks like a stock, but it is not a stock. So very, very important to understand that before you invest in any of these companies. Moving on to the next Chinese stock, we have Baidu. Now this over the last year down 29%, over the last 10 years down 37%, and we can see here all-time high $340 2021, again towards its 52-week lows and a forward P of just under 10. This one, unlike the first 2 we discussed, Alibaba and JD.com, doesn't currently pay a dividend. So let's take a look at the metrics. Market cap 37 billion. It is a large cap company. In terms of the free cash flow per share, it has been increasing. $29 in 2013, $51 in 2022, expected $71 in 23, $73 in 2024. So nice to see. Whilst it isn't consistent year on year, over the longer term, it is increasing at a fairly strong rate. Several key themes here that we're pulling out, that we're seeing in both Chinese stocks. Number 1, Alibaba, number 2, JD.com, is the fact that their top line does seem to be decreasing over the longer term. But again, this is something you should consider before investing, whether or not you see this as an actual trend or just a hiccup in the road. Total sales, though, it has grown 32 billion to 124 in 2022, 131 expected in 2023. They've also done some share buybacks, share issuances. Over the longer term, they have diluted your position, although minimally by around 3 million shares. ROIC, again, similar. It has been decreasing a little bit too low for my liking at 5 to 6%. If you do sign up to the newsletter, you can see the exact metrics I do look for. 6%, I would like to see that around 10. Free cash flow margin, operating margin. Now, whilst the last few years aren't terrible and they are around what I like to see, it is just a little bit of a concern to note that it has been decreasing over the last 10 years. And again, I would draw your attention to that before investing in any of these companies. Similar to the first two, very strong balance sheets based on the information we have. It wouldn't take any of those 3 one day to pay off all of their cash or all of their debt net of cash on hand. So what about the analysis, the intrinsic value? So let's get right to that. And as always, you can grab a copy of this model if you want to get to the intrinsic value, as well as the acceptable buy price of companies in your own portfolio and on your watch list by clicking on the pinned comment. Margin of safety at 10%, a buy up to 128, at 20% at 114, and at 25% pretty much at the current trading price. So for Baidu, we see a 25% margin of safety, and Wall Street see 55% upside. Price target of 164 over the next 12 months. So again, similar to the other two, a lot of upside, and they are buying a lot of these shares of these companies. We then move on to the next one. Now, this isn't one that is at its 52-week low, in fact, at its 52-week high, but we have added it today as it is one of those that the institutions and analysts and hedge funds themselves have been adding to. It is TME, Tencent Music Entertainment Group. They're up 13% over the last year. Over the last 10 years, we can see, in fact, from 2018, it was trading at $12. So similar again to the other companies, they are lower right now than what they were traded for a few years ago. And we can see all-time highs at around $30 in 2021. Now, their PE 18.68 and they don't currently pay a dividend. So let's get into the metrics. 15 billion market cap, a large cap company. In terms of their free cash flow per share, 91 cents in 2016, $4 in 2022, expected higher in 2023's annual report, and a dip in 2024. So again, longer term, it is increasing, but there are some inconsistencies year on year. Again, another similar trend that we are noticing, their top line revenue has been decreasing over the period, and it is a bit of a disaster in my opinion. The last 2 years, negative growth. So again, personally, if I was to invest in TME, this is something I would do a more or a larger, deeper dive to understand why their top line has been increasing or decreasing over the last 2 years. Total sales though, 4 billion in 2016, 28 billion in 2022. Nonetheless, while there are inconsistencies, it is growing year on year. Shares outstanding, again, your position is diluted. Not that it's bad, but it always should make up your investment thesis and understand whether or not, one, you're happy with it, and two, to put that into your margin of safety. 950 million in 2016, 1.59 billion expected in 2023. Now, ROIC, very inconsistent year on year, but again, 7% in 2023. Whilst not being the worst metric, it is one that I would just consider as part of your thesis. Operating margin, free cash flow margin, nothing really to note here. The operating margin has been increasing over the period. 16% positive in 2023, one of the lower ends that we would look at. Free cash flow margin, very strong continually over the last few years. So that is very positive for Tencent Music Entertainment Group. Also, nice to note here, pretty much all of them have a very strong balance sheet. It wouldn't take either of them one day to pay off all of their debt net of cash on hand. So again, they do have a strong balance sheet. And if the last two that currently don't pay a dividend started to pay a dividend, based on the information we have, it would look to be very safe. So let's get to TME's valuation. And don't forget, if you do enjoy the content, values being provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Margin of safety at 10%, a buy up to 10.94. At 20%, we can see pretty much a few cents shy. So for TME, we see a 20% margin of safety, probably one of the lower margin of safeties of the Chinese stocks we have reviewed today. Wall Street, however, they see 16% upside, a price target of $11. So again, this is one of those that they don't see the most upside. However, if it wasn't a Chinese company, maybe you would be happy with 16% upside, but maybe you're thinking you want a larger margin of safety and you want more of an upside so that the risk is outweighed by the reward. As always though, do let me know your thoughts in the comments below. Are any of these the ones that you've been looking to add? Or is just the Chinese risk, the regulation, geopolitical issues one that makes you want to avoid all stocks? And let me know your thoughts. As always, have a great day. See you on the next episode. Smash that like button. And for now, take care.